Okay, welcome everyone. We'll start our lesson 3. Today lesson will go through LO3. As you know me, my name is Anjum Satar. Please, if you have any question, drop me email. I will try my best, get back to you as soon as possible. Okay, so lesson 1, we discuss about international accounting standards. And today lesson will go through LO3, which we'll look in a minute. And we discuss about 5 professional code of ethics. We went through consolidated financial statement in last lesson, and we discussed, how we can and why we need to be prepare the group statement. And that was in our previous lesson, our discussion. Okay, thank you. Okay, I'll share with you the slide in a minute, and then we'll start our lesson. Okay, welcome everyone. Yes, we'll start. So today lesson will go through our be able to prepare the financial statement for a group of entities. Entity mean organization, which will go through. So we'll go through parent, subsidiary, and associate companies. As we discuss the aim of this unit, please, what you know about the financial statement? Anyone, any thought? Okay, what's your contact number, please? If you give me, I'll request, how we'll try to include you on the WhatsApp group. And what's your name, please? Sorry, it's because your name only coming H. I'm not sure who is. Okay, welcome. Let's please, so in the previous lesson, we had a discussion about the statement of comprehensive income, statement of financial position, statement of cash flow. We discuss about IS2, financial statement need to be true and fair under IS1. We discuss about inventory need to be record, net realizable value at the cost, whichever is the lower. And we went through the first inventory evaluation method in our lesson. Okay, so let's please, we discuss today parent. What is meant by the parent company? If you own it 50% or more, you will be known as a parent company. Other company will be known as a subsidiary. Associate, if you own the shares of 20 to 49%, that will be associate. And if you're less than 20%, that will be your okay. So if you own, the 20%, less than 20%, that will be simple investment. So parent is if you own it more than 50%. Other company will be known as a subsidiary. Associate, if you own it as a parent, 20 to 49% will be associate. If you have less than 20%, that will be known as a simple investment. Okay, so today lesson, which will go through all our parent, subsidiary, and associate element, and we'll go through the financial statements, how we can merge together and prepare. Okay, so please, first thing, we'll go through statement of cash flow. So statement of the cash flow, prepare the group accounts of statement of cash flow. So we under IS7, we can prepare the statement of cash flow. So we look around the 3 activities under the cash flow of the whole group company. So we can look around IS 7, International Accounting Standard 7. Either we can use the direct method and indirect method, whichever method you use. So please, that's which we need to be. So under indirect method or the direct method, that's the simple layout. So under the cash flow, we're looking three activities. And operating activities, which is mean our normal business like a Tesco. They do the FMGs, fast moving consumer goods, daily goods that's they selling. And we can look around their main business, how much is the profit before tax they have. We can look around the finance cap, depreciation and all. We'll make the adjustment. And then if you want to look around, technically we're looking the changes in that current asset during the years, the previous year and the current years, and we can prepare the statement of the cash flow, and we look the cash flow statement. Okay, under the direct method we can say cash received from customer, which is mean the trade receivable changes. Cash payments, we look the changes in the trade payables. We look the cash generated from operation during the period, and the interest paid we minus and the tax paid we minus, and then we can find it net cash from operating activities, how much we have. That's is quite crucial, which we need to be look around. Okay, then we can look around investing activities, how much changes in the non-current asset during the year which happened. So that's which we look under the under the under the non-current asset register, and the changes. So we can look around the property non-current asset like property, plant, equipment, how much we bought, we disposed of, cash and inflow, and if we have receiving the interest, we look those are the dividends we paid. That's really we need to be look around the net cash flow from investing activities. So please, if you have any question, you can ask anyone any question. Okay, then we look at the financing activities, so proceed from the issuing shares. We look around the increase in the bank loan during the years, the dividend paid. So in and outflow under the financing activity, it can be debt and equity financing. And we look, the how much is the cash increase, and the opening balance we increase, put, and then net cash inflow from all these activities. Okay, that's we look, how we can add them, and that's quite crucial, which we need to be look around. Okay, yes, no problem, which I'll request to add. Okay, so we went through investing, operating, and financing activity. That's really we need to combine them, their cash flows, how much we have under each, the parent, subsidiary, and associate the cash generating from operations, which we look interest, and the tax we look investing activities, we look, changes in finance activities and cash and cash equivalent. So that's, really we need to be look around when we'll go through the activities. Some, when we'll do the assignment discussion, we'll add, these example in to address the learning outcome. Okay, advantages, of course, cash is a crucial. We need to be look around. Cash really matters, and the facts and figures is not easy to manipulate and not affected by the accounting policies and limitation. Cash balances can be manipulating by delaying the payments. Yes, that can be made after the statement date. You're making the payment, not before the date, so the cash balance can be impacted. That's hugely which we can. Okay, so please, I gave you the Osborne handouts, which is on our Moodle page. So please, we can look around 6.3 and 6.4 question, which is about the cash flow, and that's the question we can, and you've been given the answers for the question, the changes with all working, which we look, okay. Move to the next, which we're looking IFRS 10. A group of company consists of the parent and subsidiaries and associate, we call the group. And within the group, the parent is the entity that's controlled one or the more entities, and the subsidiary is an entity that controlled by another entity, and consolidated financial statements of the group in which the asset, liabilities, and equities, income, and expenses of the parent and the subsidiaries are presented and controlled. And that's really we need to be look around the power of the investees, how much we have, the that's which we look. Control is very important. We look around the group structures, how much control you have. We look the non-controlling interest between the group and their voting rights as well, then current preference and the non-preference shares, that's also is quite crucial to look around. Okay, so step one, when you make the consolidated, so please draw the group structure, how much shares we are going to be acquire from. Okay, how much purchase consideration, how much money you paid. If you paid more than the net asset, look around the please accounting equation, asset minus liability equal to net asset. And if we are paying more than the net asset, that will be known as the difference between them. That will be our goodwill, which we'll go through in a minute. Okay, controlling in non-controlling interest. If you're acquiring 80% company PR to S, so 20% will be your non-controlling interest. If you have the retained income, which is previous period, that's 20% of that is we don't have a interest in. Fair value in adjustment, if the asset value is being fluctuate, so that's the 20%. Like if the land was 30,000, now it's 50,000, so 20,000 after 20%, that's we look, when we add them all, that give you the figure of the non-controlling interest at acquisition date, how much we have. Okay, then we look at the goodwill, calculation of the goodwill. Okay, so please no worries, because you're not doing exam. It's a matter of, you're adding the example. So I'll add it, some examples for you, which we can look around, and that's, quite crucial, which we need to be explore about. Okay, so we can look around the consideration, a non-controlling interest in the step one, net asset acquired minus, and then we look at if any goodwill being impaired, that's, which we can, and then we can say how much is worth of the goodwill we have here. Okay, so please then what you need to do when you preparing the group statement, please, you have to look around the calculate the consolidated return, earning and reserve, all the parent subsidiaries at the year end after the acquisition, and how much was the at acquisition return earning. Thus we need to minus 80% of that, and then please, the group shares we need to be calculated. That's quite crucial, which we need to be, if any impairment, goodwill we need to minus, and then we can say, calculate the non-controlling interest at the year end. So share capital of the S Limited at the year end, how much we have. We look at the return earning, how much we have. Fair value adjustment, if any, will do in the non-controlling interest at the year end. That's, is quite crucial, which we need to be look around. Okay. The step 6, please, we need to be look around the liabilities. We can look around the non-current asset, intangible asset, which is mean goodwill, and then other non-current asset. When we add them all the parent and subsidiary, the percentage, of non-current asset, whole, 100% of the subsidiary and the parent. Goodwill we have calculated, and then that will become, and the current asset, all the parent and subsidiary. If they have intra-company trading, that's we need to be eliminate, accordingly, like, one giving loan to others, and one is the receivable, one is the payable, that's we need to eliminate. Okay, then we have the share capital, only the parent and the subsidiary return earning post acquisition, as we calculated in the top, and the non-controlling interest. Please always remember, total asset always equal to total equity and liabilities. That's, really we need to be look around. Debit and credit side, establish the group structure, add together the parent and the subsidiary statement, non-controlling interest, follow these steps, and then if we do the profit and loss, so you do the revenue of both company, if intra-company trading we need to eliminate, The cost intercompany trading unrealized profit, because the profit, if we are selling within the group, those we need to eliminate the gross profit and we minus all other expenses, and we can get, the how much is the parent, the 80% of subsidiaries, 80% there, and the 20% will be non-controlling interest, or we can say attribute. So that's the way we can calculate, please. We can debit the revenue and credit the sales, if we need to be reduce intercompany trading, the entries we can show, and thus we need to make adjustment in our book of accounts. Okay, so further points, please, we need to be consider the okay, thus we need to be make sure, when we prepare the consolidated statement, welcome, thanks for joining. Consolidated financial statement must include all the subsidiaries of the parent, and consolidated financial statement must be prepared unified accounting policies, whichever you make as an organization. So please, in our handout, which is 8.4 and 8.5, which is Osborne handouts, please, which is available on our Moodle page. I'll share with you in the chat box. We can look around the question 8.4 and 8.5, which we'll go through. And next week, when we'll do assignment discussion, we'll solve them, and we can put, those questions in our assignment answers. Those, we can include the data, and we can prepare, if you're demonstrating that's, addressing the learning outcome, which is learning outcome 3 we are looking today. Okay, so please, today we discuss about 3.3, prepare the group accounts between the group, in one company. If you're own any other company 50 or more than 50%, that will be known as a parent, other will be known as subsidiary. If you do so, if you own more than 50%, the other company will be known as subsidiary, and you will be as a parent company. If you own 20 to 49%, that will be known as associate. So that's really we need to be remember the group structure. And if you do less than 20%, that will be known as simple investment. Like we don't have a fully controlled, we can't change their management. So these elements, we need to be look around, and that's the 9 IS 27, we look the consolidated and separate financial statement of each, the group we can prepare within, which we look, some examples. Consolidating income statement and profit and loss, we can prepare the revenue and the sales we can add together, of the both parent and the subsidiary. Intra-company, if we are selling between the group, we need to, any profit we make, we need to eliminate it. And then please, we need to look around all these, in a perspective. So that's, is quite crucial, which we need to be look around. That's, really we need to be look around in those perspectives. Okay, plus I included the link for you here, please. A useful link if you want to pick some example about the parent and the subsidiary, please do so. And please, I included 8.6 question. We have open tuition. If you look financial reporting F7, please, and the Kaplan website, which a couple of times, I mentioned you, that's quite good to look around. Okay, I can quickly share with you the handouts, please, in the chat box. Can you hear me okay? Yes, please. Hello, can you hear me? So I'm sharing with you. Okay, great. So what I'm going to do, I'm sharing with you the handouts which we'll use, and that's, which we're looking financial statement, and I refer the questions, in the handout, in our PowerPoint slides, please. We can look around before next lesson, the question and answers all I'm sharing with you. So please, if you look the working, because the layout, which I just mentioned in our slides as well. And when we'll do assignment discussion next week, what we do, we can pick some question from these handout or any. I'll share with you 2-3 different authors book, those we can use for the sake of, to prepare assignment, and we can reference them and the data we can obtain from, and we can look around. Of course, we can prepare from these handouts. Huh? Okay, just 1 second. I'm sharing with you Osborne handout first. Give me 1 minute, please. Sorry. Level 4, level 5. Give me one. I'm sharing with you. Okay, so please, if you check in the chat box, I'd shared with you 2 documents. Yeah, that's fine. Fake company mean it can be any company, dummy company. Yes, you're right. We don't need original companies. Absolutely fine. So there you can pick the question from the handout or from the books, and we can write it, and underneath we can. So there is a intra-group trading, but we have, those how we can eliminate them. That's, which we can pick from this handout, this booklet, which I just shared with you. I can share with you F7 as well for you. So which is we use for ACC. I shared with you. This one is the AT. Normally we use these books, but is absolutely acceptable because at the end of the day, it's the same topic, we need to pick. So I shared with you these, and then I'm sharing with you F7 of ACCA1. That's also quite good for financial reporting, which will cover all our key elements, So I'm sharing with you tutor and the student copies, both handouts. Okay, yes, please. If you check in, and you can download and you can save your end, these are available on our Moodle page as well. So today, guys, we discuss about the group infrastructure, and we discuss parent. If you own it more than 50%, your parent. If you own 20 to 49, other company will be your associate. If less than 20%, that's we call simple investment. And we discuss IES 27, and we discuss IFRS 10, and in our discussion, we discuss about the consolidated statement between our intra-company trading. We need to be eliminated, So what we'll do, we'll look the actual question in when we'll do the assignment discussion. And thanks for attending today lesson. Tomorrow we'll look our LO4, and next week, we'll do assignment discussion. Please make sure next week, so listening this recording, please make sure you attend. So we'll go through good few questions, and within that, we'll explain how we can address, all the learning outcome, and we'll recap, LO1, LO2, LO3, LO4, and we'll go through how we can structure assignment. I'll share with you the sample assignment, and that's all will be in our discussion in the next week. Yes, because this is not exam-based course, it's only assignment-based course, and you need to get the concept, and you have to answer the question. You have to pick the company to meet the learning outcome, and you have to prepare the consolidated statement, which you have to demonstrate. That's all, from my end. Any question, please? Any question, please? No question? Hope you can hear me. If any question, please, you can ask. Otherwise, we'll keep to. Okay. Many thanks for attending, and have a lovely weekend. I'll speak you during next lesson, which will be tomorrow. Thank you. Bye now.